Hello and welcome to Chapter 3 in Tax 1. In this chapter we'll be looking at gross income, what we include in gross income and what we can exclude from gross income. And then I'll be kind of using the e-text in this presentation, and we'll be touching upon some of the problems that you'll have in Connect as well. So let's begin then by looking at what a cash receipt and disbursement is. As we know or are learning, in individual taxation, most taxpayers report on a cash basis. And so if someone receives or constructively receives cash, they must report it as income. So what is constructive receipt? It's generally income that's reported and the taxpayer receives the right to it. So if you have received a right to it and maybe you had the cash has not flowed yet, that may be considered constructive receipt, depends upon the circumstances. If you receive property or services in lieu of cash, that is still income that needs to be recognized. So for example, if two taxpayers were bartering or exchanging services or property, generally it must be reported as income. So if I do somebody's taxes for them, if I do some consultation, and they pay me with a goat or a pig or a cow or fixing my car or whatever compensation they decide to barter, I have to report that, the value of that, those services provided as income. Most income is subject to taxation, but not all, and we'll discuss some of those. Interest from banks and credit unions, for example. You might get a statement in January, for example, a 1099 INT if you earned interest of more than $10. Interest earned on governmental issued Series Z and EE savings bonds can be taxable. There's a unique provision, though, in the tax code relating to Series Z and EE bonds, and that is that you can report the income over the maturity period of the bonds gradually, or you can report them at full maturity. And so if you're calculating this based on your current and anticipated tax position, one may be more beneficial to you than the other. Some interest received on tax-exempt debt, for example, issued by state or U.S. positions or subdivision thereof. And we'll talk a little bit about the taxation, how some of these types of debts are taxable and some are not taxable. For example, if you bought a municipal bond from the city of Madison, they were going to build a school or a bridge in Madison, and they were funding it by issuing these bonds, and you bought a bond, you've essentially lent money to the city of Madison, and they will pay you interest, but for federal tax purposes, you do not need to report that income, that interest income. It's tax-free, and more accurately, it's tax-exempt. So other types of interest, if you decide to sell your home and the buyer wants to borrow money from you, the owner, the seller of the home, and you self-finance the home, then any interest you receive on the principal that they're paying you must be reported as income. That's also true of installment sales. And we'll talk a little bit more on interest on bonds between interest dates. And then imputed interest, where there may be, if you lent money to somebody and the interest rate was below market, well, IRS, if they audit you, for example, they may impute or assign the market rate of interest, and then the difference then between the market rate and the rate you're charging your friend or relative, the lower rate, presumably, would be income and has to be reported. And indeed, the interest that you're charging this friend or related person would have to be reported as well. So both elements have to be reported as interest for the recipient of the interest. Now, what about the payer? What about the relative who's getting a break on their interest? Right, I borrowed money from my uncle. The going rate for me if I went to the bank would be 5%. My uncle's only going to charge me 3%. Well, the difference then between the 5% and the 3% that I'm paying is income to me. I have to report that as income. So this break, because we're related parties, is taxable. In this case, the 2% difference. And we report, by the way, interest on Schedule B of Form 1040. A dividend is a little bit different. A dividend essentially is a liquidation, usually of earnings. And dividends are distributions into the shareholders. If it's a qualified dividend, then it's made up of the E&P, or earnings and profits, of the payer corporation. And if we have to know if they're from domestic corporations or from qualified foreign corporations. And as we'll learn, the taxability of qualified dividends often is lower than our marginal tax rate. Stock dividends and stock splits are generally not taxable to the shareholders. If you own shares in a company and they're going to pay you a dividend, but they don't pay you in cash or property, they give you more stock, then you've really received no value at that point. Because if you own, for example, 2% of the company before the stock distribution, you would own 2% of the company after the stock distribution. You would just own more stock. But in other words, each stock would be divided into smaller pieces. And so you would still own the same proportion of this company as you did before. Now, over time, if the company grows, those additional shares may result in greater value to you and greater dividends as well. But at least at the moment in which you receive the stock dividend, they have no value. And we report dividends also on Schedule B if the dividends are more than $1,500 on Form 1040. If you get a refund from the state or local government for tax purposes, that's income. That has to be, I should say the refund is income that has to be reported. If you pay the tax in 1 year and you itemize your deductions, you get to deduct that as an itemized deduction. However, as I said, if you get a refund the next year and you've already taken a deduction on that because you itemized the previous year and deducted your state income tax, then that refund becomes taxable income to you the next year. If you take the standard deduction, however, then you would never have taken the state income tax as a deduction. Therefore, you never have to report it as income for federal tax purposes. Social Security benefits can be taxable depending upon the income level of the taxpayer. And income level in this case, we use the provisional income, also known as modified adjusted gross income. And we'll talk a little bit about that. I also provided some illustration problems that show you how to calculate the portion of Social Security income that may be subject to taxation. You're not required to do this as a part of your assignment, but it's good to know. So we'll briefly cover it in this video, and then we'll also allow you to look at the template I have in BlackBoard, and you can kind of run through the problem in the chapter and follow along if you'd like to. So this term provisional income then relates to thresholds that we use to determine the taxability of Social Security benefits. So what is provisional income then? Well, we start, as we said, with AGI, or adjusted gross income, before considering Social Security benefits. And then to that, we're going to add interest on U.S. savings bonds that were excluded originally for educational purposes. Most tax-exempt interests that we normally would not have to report. For purposes of determining provisional income, we're going to have to add those right back in, at least just for this calculation. We'll have to also include employer-provided adoption benefits, any excluded foreign income, deducted interest on educational loans, deducted tuition and fees, and then 50% of the Social Security benefit itself. So these items then are added back to AGI only for purposes of defining a provisional income, which will be used to determine how much of your Social Security benefits are taxable. That's all that these adjustments are used for. So if these provisional income that we've just calculated would exceed certain thresholds, then half of those Social Security benefits would be taxable. If the provisional income that we calculated increases to the point where it's above the upper threshold level, then as much as 85% of our Social Security benefit could be taxable. Note here those thresholds. So we've calculated our provisional income, added those items back to adjusted gross income, and now we're going to see where we land based on our filing status. So let's look at the married filing jointly on the left. The lower limit is $32,000 for married filing joint. The upper limit is $44,000. So if we calculate our provisional income, that is, we make these adjustments to AGI, and we determine that our provisional income is below $32,000 for a married filing joint, then none of the Social Security benefits are taxable. If, however, our provisional income is above $44,000, then as much as 85% of our Social Security benefits may be taxable. So, and then what if our provisional income falls in between $32,000 and $44,000? Then as much as half of our Social Security benefit could be taxable. And as I said, I have these examples that I have in my template in BlackBoard that you can run through, and actually run through a couple of examples where we determine the taxability of Social Security benefits. All right, so the taxability of components of gross income, interest, dividends, tax refunds, and Social Security benefits. As I said, tax refunds from, for example, the state government would be considered income if you deducted them in the previous year through itemization. Other types of taxable income, if you serve on jury duty, that income is taxable. Any prizes and awards you receive or forgiveness of debt are taxable. Insurance proceeds received in excess of adjusted basis of property is subject to taxation. Many fringe benefits you get from your employer are not taxable. So, for example, if your employer provides a life insurance benefit, the premiums that your employer pays on your behalf for life insurance coverage, term insurance of up to $50,000 is not taxable. So the premiums that your employer pays for you to get $50,000 of life insurance coverage, those premiums are not considered income for you. Any life insurance, however, that's purchased above $50,000, the premiums on those insurance benefits would be taxable income to you. If you receive educational assistance from your employer, up to $5,250 of that is not considered income for tax purposes. And then any dependent care assistance you receive from your employer up to $5,000 is not subject to taxation. There's a caveat here, and that is that if one of the spouses, for example, earns much less than that, maybe less than $5,000, then the dependent care assistance cannot exceed the earned income of that employee. And presumably because if you have a spouse, let's say the husband is staying home a good part of the time and just working a part-time job, and the wife is working full-time, well, if the husband earns only $3,000, but is there to take care of the kids, then the dependent care assistance received from the employer for the wife would be only limited to $3,000. Any amount paid by the employer above that would be taxable income. And again, the presumption is that someone earning less than $5,000, this other spouse or partner is more likely to be available to take care of the child and therefore avoid the need for dependent care assistance. And there are other types of income that in this case are non-taxable. So we look at scholarships and fellowships that you might receive, that's not taxable. Life insurance proceeds, not taxable. And life insurance is really important, I think, for families who have children under 18 who are relying on the parents to take care of them. Life insurance, term insurance specifically, is very important to have that. And what's great about life insurance is that if the unfortunate occurrence of the death of the parents, one or both parents, comes to pass, then what the life insurance company then will, upon proof of death, they will send the check for the life insurance proceeds directly to the sponsor or the caretaker of the children for their benefit. And the life insurance benefits, it avoids probate. So it's not going to be held up in probate court. The money is immediately available to the person or family who's taking care of the children who've lost their parents or their significant others. So life insurance is quite beneficial when there are small children involved. Gifts and inheritance can be taxable. You need quite a bit of income for the inheritance to be taxable. Gifts up to about $15,000 is over that is taxable. Under 15 per year per taxpayer is not taxable. Compensation for sickness or injury is generally not taxable. Child support. If one spouse, the husband, receives child support because he's taking care of the children and the former wife is paying the child support, then that child support is not income to the receiving spouse, nor is it, or ex-spouse in this case, nor is it deductible by the paying spouse. That is not the case, by the way, with alimony. Alimony is a little different. Alimony or maintenance is taxable by the recipient, and it is deductible by the payer. But child support is not taxable, as I said, by the recipient and not deductible by the payer. And then up to a limit, employer-provided adoption assistance is not taxable and can be excluded. Welfare, of course, is generally excluded from income as well. I mentioned savings bond interest a little bit earlier. These are specific rules that relate to the tax accounting for these types of investments, or like savings bond interest. Not taxable if it's used to pay higher education expenses for taxpayer spouse or dependent children. Full exclusion allowed if educational expenses exceed the redemption amount. And then limitation, there is limitation here for modified adjusted gross income. And these generally change periodically, but for a joint return, if modified adjusted gross income exceeds $121,600, then the savings bond interest can be taxable. Anyone who receives, and I mentioned this earlier, below market interest loan, the amount of interest you're being charged by presumably a related party is less than the market rate you would have paid had you gone to a bank to take out a loan. That is income to the person receiving that discounted interest, the person who borrowed the money. And then there are examples of where we would also, the imputed interest would not apply, and that is for short-term loans or loans for sale of property of $3,000 or less. So a gift loan, I mentioned that before, the imputed interest rules apply to gift loans over $15,000. So if you lend money to somebody you care about, for example, and then you forgive the loan, and you say, you don't have to pay me back, that becomes a gift loan. If the gift loan is less than $15,000, for example, then nobody has to pay tax on it. But if someone forgives a loan that was maybe $20,000, then the amount over $15,000 is subject to taxation. What I wanted to mention, in addition to what we've been talking about regarding interest and what is received, what is taxable interest, what is tax-exempt interest, when we report interest, I mentioned earlier, we report on Schedule B. So this is what the 2019 Schedule B would look like. I mentioned you'd report interest on line 1, and then on Part 2, you'd report interest on line 5, dividends, on line 5. So you'd report dividends here. And generally, so if it's over $1,500, you report it here. And that's also true of interest over $1,500. That's kind of the threshold. If it's less than that, you don't really need to record it here. You can just report it on page 1 of Form 1040. So I want to show you this. And then just a couple other forms. Here's the interest income, 1099 INT that you might receive from maybe a savings and loan or from an investment company. Reports the interest, any penalties, the type of interest, whether it's interest on U.S. savings bonds or treasury obligations. If it's tax exempt, it's foreign paid. I mentioned earlier also that dividends are taxable at generally a reduced rate. So they might be taxed at either 0, 15%, or 20%. And usually it's at a lower rate. You get a special rate for dividends and capital gains than what you would pay on your ordinary income. So you might want to review this part of the taxation of dividends as well. And here's a distribution then, 1099 INT, for the distribution of dividends. And then finally, I wanted just to run through some of the assigned work you might have this week. Bring that up here. Yeah. All right, so, and I'll make this a little bit bigger. I'll let you run through the template yourself as well, but a few things I wanted to point out here. On problem number 2, which ties to number 35 in the text, and this happens to be a connect question as well. I've changed the data a little bit. We have some independent situations here, and we have 5 of them. And just to look at a few of them, let's look at A here. A taxpayer completes $600 of accounting services in December 2019 for a client who pays for the accounting work in 2020. So A says income from accounting services in 2020, although remittance occurred in 2020, the amount of taxable income to report is 19. In 2019 is 0. And the reason that that's the case is that most taxpayers are not on an accrued basis. They're on a cash flow basis. And since the money did not flow to the person providing the accounting services until 2020, they would report that in 2020. So as you're answering some of these questions, just kind of keep in mind that individual taxpayers report income generally on a cash basis. I want to run down to E for a minute here. I talked a little bit about bartering before. An accountant agrees to perform $550 of tax services for an auto mechanic who has agreed to perform repairs on the car of the accountant's wife. The mechanic repairs the car in December 2019, and the accountant starts and completes the tax work in March of 2020. So if we have to look at when each of these parties has to report income, because they both do. They cannot avoid taxation because they've exchanged services. They've exchanged value the same way as though they would have paid each other cash. And they have to report that as income. So, the value exchange between the accountant and the mechanic, using my altered data. Now again, you will have different data for these demonstration problems in Connect. But I've changed some of the data just to demonstrate how some of these problems are resolved. So I'm using my numbers. The value exchange is $550. Income reported by the mechanic in 2019. Well, the value a mechanic received his value or her value in 2020. Therefore, the mechanic has no income to report. Amount of income reported by the accountant in 2019. Well, the accountant received value in 2019. If we scroll up to the problem here, we see the mechanic repairs the car in December 2019. So the accountant has received the value of the mechanic repairs in 2019. Therefore, the accountant has to report the value received, the repair of the car, in 2019. Moving over to 2020, now the mechanic has to report value of $550 because in 2020, the accountant provided the services to the mechanic. Therefore, the mechanic received value, and the mechanic has to report that value in 2020. And of course, in 2020 for the accountant, well, the accountant, she already reported her income in 2019, therefore she wouldn't report it in 2020. Okay, just a couple of things to keep in mind, and there are several others here that relate to some of the things we talked about earlier. There is another problem we can look at, number 37 for Nancy. Again, I've changed the numbers. Nancy is 59, beneficiary of a $195,000 life insurance policy. What amount of the insurance proceeds is taxable under each of the following scenarios? All right, so she receives $195,000 using my numbers. Amount received, $195,000. Amount taxable is 0. Life insurance proceeds on these term policies, when they're paid out, is non-taxable. That's why they're so valuable in estate planning for families when one or both of the parents die and the minor children are left. Just a really valuable tool. And then we'll scroll down and look at C. Life expectancy of the taxpayer in years is 25 years. life expectancy of the taxpayer in months is 300, so I just multiplied the 25 years times 12 months. So I have 300 months. Amount of each monthly payment is $1,400. So if we scroll up to C, we see that she received $1,400 over her remaining life expectancy, and we assume she'll live 25 years. So the total amount to be paid then is going to be the $1,400 per month, right, times 300 months. So over the life expectancy of the 25 years, or 300 months, she will receive $420,000. Amount of taxable proceeds per month then, we would take the total amount to be paid, the $420,000, and then we're going to subtract from that the lump sum of the policy, which is $195,000. And then we'll divide that by the number of months of 300. So these are the amount of the proceeds that are taxable per month, the $750 per month. One thing to keep in mind is that the $195,000 value would not be taxable. So of the $420,000 that was received, $195,000 of that is not taxable. So we take, as I said, the difference between the $420,000 and $195,000, and then finally we divide that by the number of months of 300, and that will give the amount of the proceeds that are taxable per month, the amount over the face value of the policy of $195,000. All right, so I just wanted to show you that. And then, as I said, if you want to peruse some of these problems I have, they relate to number 40 and number 42 in the text. And these are Social Security problems. They help you to determine how much of the Social Security benefit, if any, is subject to taxation based on different provisional income amounts. These are not assigned, but you're welcome to study them and let me know if you have any questions.